Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The latest GDP numbers show the Indian economy grew at 7.6% in 2016, in line with expectations. However, the fourth quarter grew a surprising 7.9%. Now, the good news is that private consumption, which grew at 7.4% for the year, showed considerable resilience. It also stayed strong for the fourth quarter too at 7.6%. Another surprise was agricultural growth for the quarter, up 2.3% against a negative 1% in the previous month. So on the other hand, investment activity is weak. So what are the latest GDP numbers telling us, and what is the outlook for the current quarter and year? What are the concerns? Let's try and address those with Madan, Sabnavis, Chief Economist at Care Ratings, at Sujan, Hajra, Economist at Anand, Rathi Securities. Thank you both for joining us. So Madan, let me begin with you. What are the broad takeaways, considering that there is a lot of confusion yet about what these numbers really mean?
Govind, we've still seen right from the time when this new methodology came in that there has been anomalies between what's happening at the physical level. When I say physical level, if I look at the physical production numbers in agriculture, in industry, or even for that matter, your banking sector, and what we are seeing in terms of value added and what appears in your GDP numbers. So I think this kind of an anomaly continues to remain there, and it's a bit baffling because we're not able to reconcile low IIP growth with very high growth in value added and value addition in manufacturing. Similarly, agriculture, both Rabi and Kharif doing worse than what it was last year, but we still see positive output coming from that particular segment. Banking sector has all kinds of travails, but we still see a growth of around 9.5%. So I think these are some things which are not able to reconcile. I think it's all happening on account of the new method of calculating, where we're looking at including also the taxes which are coming into the picture. We're also looking in terms of value addition, in terms of new kinds of commodities which are coming in, which have higher value but lower physical number. So I think this is going to continue, this will remain with us for some time. But I think the right way to look at these numbers is don't look at 7.6% number per se, but look at the improvement or the deterioration over the previous year. So from 7.2 we moved to 7.6%, which has been a positive sign. Because if you remember, even when the UPAs last year, that is 13-14, when the old methodology had 4.7%, we had a number of 6.6% coming in the new methodology. So it appears that 1.5 to 2% would be the difference between the old and new methodologies.
Hold your thought there for a second. So, Sujan, let me begin you in. I mean, before we go into what this means on a more forward-looking basis, what are the key takeaways for you? I mean, in terms of what the numbers reflect and what they don't reflect.
So in terms of, see the bigger trend, if you look at this number, obviously, as you said, the consumption is holding up. If you look at the...
What explains that?
Basically what is happening is that urban consumption since 2014 is doing pretty well. Second thing, the trend is that your savings rate, the net savings rate of the households have actually gone down 50%. From 27% of GDP has gone down to 18% of the GDP. So you are basically reducing your savings and you are consuming, whether out of distress or whether out of choice. That's a different thing altogether.
But is this a significant move, the drop in net savings?
Absolutely. Absolutely, it's a
in a long time.
This is happening, between 2004 to 2008 when the days are good, or the savings rate actually didn't go up. But this is the first time we are seeing the net household savings rate actually is falling. The change in overall,
which is translating into higher consumption.
That's sustaining higher
and that
consumption.
would be considered good as well, right?
That's true. That's true.
Okay.
Yeah. So the point is, but at the same time, what we are also seeing that there is no pickup in investment. So which is the worrying part, because India has never grown strongly without strong contribution from investment. Though as a percentage of GDP, investment is much lower than the private consumption. But without strong investment growth, you cannot expect realistically to go back to 9% plus kind of a growth.
Right. Okay. But then the other question is on agriculture numbers. Is that reflecting what the situation on the ground is?
No, definitely not. Because I think even here when we're looking at agriculture, I think the CSO has clarified that looking at two segments. One is the conventional agriculture which we talk of. Second are the allied activities. And to my mind, it's the allied activities which have probably added a lot to the value addition, which has brought about a positive growth. But otherwise, if we're looking at most of the crops, I think with the exception of probably wheat, they've all shown lower production numbers compared to last year. So definitely there is a difference at what's happening at the ground level and what we are seeing in terms of the GDP number.
Right. So if we were to now look forward, Madan, what's your sense? If we were to take all these numbers, we would take the combine of where IIP growth is, where exports are, where our ability to spend or current spending patterns are. What does this add up in coming months?
Now, to my mind, I think things will move slowly in the upward direction. And the reason for it is that we have seen certain stimulants which have been provided by the government, certain kind of responses in specific sectors like say automobiles, maybe the construction sector, which could probably be adding to the overall demand forces in the country to push up the GDP growth rate. And then, of course, we will also be having a case of saying that with lower interest rates, stable exchange rate, the external environment as provided by the RBI, that could also be congenial to bring about growth. But I wouldn't really expect any kind of radical change. With a good monsoon, rural demand picking up, I think we should just about move towards the 7.8% mark.
Right. So, Sujan, is some truth in the fact that the private sector is now performing much better, and to some extent that is also being reflected in the way GDP numbers are growing, particularly the last quarter?
See, again, if you look at the manufacturing sector, manufacturing obviously in terms of GDP, it's apparently doing very well, but the IIP number doesn't reflect that. But having said that, if you look at the say earning figures, there is a certain kind of improvement there, especially what's happening while the top line of the companies may not be increasing too much, because you are still in a deflationary kind of an environment. Or prices of those products are not going up, but the margins are improving for the companies, especially because the cost raw material costs have gone down, the wage cost has not gone up very significantly, and this trend is likely to continue.
Companies are becoming more productive. Yeah.
Absolutely, and your operating leverage is also kicking in with if the cost of fund now goes down, which is likely to go down, that will be another kicker. So you might see a situation when the corporate earning is doing well, despite very strong top line growth, just because you sustained high margin.
So that despite lack of sustained top line growth.
Yeah, irrespective of that.
Irrespective of that. Okay, right. Okay, so Madan, if you were to look forward once again, now what are the 2 or 3 areas that are likely to play a critical role? Monsoon obviously being one. Is there anything else that you're looking at, including oil prices, which we are going to talk about a little later in any case?
No, I think private investment is the important part, because what we have seen in the last 3 years is that capital formation has been coming down consistently, and we need to have more capital being invested. Now, capital is invested both in infrastructure as well as manufacturing. Now, given the low capacity utilization rates in manufacturing, I don't think there will be a major pickup in the current year. Definitely not for capital goods and basic goods. It could probably happen for consumer goods. Then we turn over to infrastructure. We need to see whether the private sector gets in. See, so far there's a lot of noise which has been made about the government spending on infrastructure, but to my mind it's a very small amount. We need to have more of private sector participation, which I don't expect to come in big doses this year. So it's going to be gradual investment from the private sector, stable investment coming from the government. Combine this with household consumption, things would be looking better than last year.
But then let me ask you another question, which I'm going to pose to Sujan as well. What's the one proxy that you look at which gives you comfort that the economy is growing at a certain pace?
No, I look at bank credit to manufacturing and services, that is to the corporate sector. So in case this particular number shows an increase, then I would take it that there is activity taking place. The last year we saw a growth was 4.9% compared to 5.5%, much lower than the double digits numbers which we've had in the past.
Right. What about you, Sujan? Is there a proxy, or 1 or 2 proxies that help people understand, including our viewers, which would give them some comfort about which way this economy is going?
Traditionally, the closest proxy to GDP growth has been diesel consumption. But having said that, these proxies work for a particular period of time. The relationship is not unidirectional, and the goodness of the feed also varies over time. So I would rather say that it's very difficult to replicate GDP with one or two indicators. But having said that, I think still the diesel consumption should be
good
fairly
indicator. But then, is that something that you look at as well, diesel consumption?
No, unlike Sujan, I would consider this to be secondary factors, because the quickest indicator we get on a fortnightly basis is bank credit. So therefore, I would still stick to the bank credit indicator.
Okay, so another question, Madan. So now this makes us a $2 trillion economy. Now, if you were to look at where we stack up in against the rest of the world, what are the kind of challenges ahead of us? Because at 2 trillion, we are big, but yet, there are many economies, including maybe smaller ones in terms of population and size, which are much larger.
No, in fact, Govind, I think we normally tend to get carried away by the $2 trillion and the fastest growing economy things. But I think what are really important is have I been able to create enough jobs in the market, so that I'm able to elevate the conditions of most of the people. And second, I think sometime back almost at the same time we had this World Hunger Index which came out, which actually doesn't put India in good light. So I think that we have this obsession over the GDP number, but we're not really looking at the quality of this GDP. So I think that's where the focus should be, to try and make sure that the people at the lower levels are better off, rather than just looking in terms of corporate profitability, which has become a habit these days.
Sujan, what's your sense? I mean, $2 trillion economy, does this mean that as the fastest growing large economy in the world, we've arrived someplace, or long way to go?
No, this obviously means something, because we could, despite everything, we couldn't do these things before. So it means something. But having said that, if you are talking about India, you are talking about for India. The bottom 50% of the population, they have a per capita yearly consumption less than $1,100. They are in abject poverty. Then the surplus
against an average of about 1450.
See, the point is that for the overall emerging market, this percentage is much lower.
Okay.
Now you have the 51 to 75% who have a per capita consumption of less than $3,100. For other countries, it forms 25%. For us, it's a much smaller segment. It's really the top 2% of the population with consumption of more than $3,100 who are actually calling the shots. But having said that, they also form 2 crore population. So that's basically you are talking about 20 million population. So it really depends on from which perspective. Are you looking at it from the corporate perspective? Then you still have a very affluent big market. At the same time, if you are talking about from a public policy perspective, your priority has to be to uplift the bottom 50%. And in some sense, I would say this government is taking some step in that direction.
Right. And of course, we also have a long way to go.
Absolutely.
And we've run out of time as well. We need to go in for a break, but coming up on the other side, oil prices are now beginning to rise. What does this mean for this country and for growth prospects? Stay with us. Welcome back to Policy Watch. Petrol prices were hiked by a steep 4.47 rupees a litre and diesel prices by 6.46 rupees a litre in the last 5 weeks. Now making that 3 price increases since May 1st and taking pump prices to their highest level in a year. International oil prices are now up 80% from a 12-year low hit in the last year and past $50 a barrel now. Now this is largely due to sustained declines in US crude oil inventories and production elsewhere in the world. But the worry now seems to be that more than 12 months of low prices and cutbacks in spending by oil companies are resulting in shrinking supplies. Prices of diesel and petrol are affected by oil prices as well as exchange rates. A weaker rupee means paying more dollars for a barrel of oil. So given the current price, where can we expect oil prices to go this year? And more importantly, what could oil prices do to India's economy? To discuss this, I'm joined by Debasish Mishra, Senior Director Oil and Gas at Deloitte, and Dr. Brinda Jagirdar, former Chief Economist at the State Bank of India. So Debasish, let me begin with you. Let's get a broader sense first. Where are oil prices going and what explains the huge jump that we've seen just this year?
It's definitely what you mentioned, that the capex have been cut tremendously. The amount of money that's spent on exploration, on production, on rigs, everything is cut dramatically. And
what's the usual time lag between, let's say, cutbacks happening and it affecting production and oil prices?
On the margin, what is getting affected is the shale oil things in the US. A lot of companies are going belly up. They are the guys who are the marginal cost of production. For many of them would be in this range, $35, $40. And many of them had taken huge amount of debt and they are not able to service and declaring bankruptcy. So that's what is affecting. And if you look at the last few months trends, obviously the non-OPEC supplies come down. And the OPEC supply has gone up. And the most affected in the non-OPEC supply is the US supply.
Right.
So, and that's what is there in the margin, and it was always known, in this kind of a war, there will be the player in the margin who would be getting killed first. So it is the Canadian oil sands, the shale and tight oil in the US, these are the guys who are getting out of the margin.
Right. Okay, so let's look at India now for a moment, and we'll come back to the world. Brinda, what's your sense now as prices rise in India? Is there a ratio that I can look at which could say that okay, up till this point we are okay, but after this point is when we should start to worry?
No, India imports 80% of its energy requirements. It's also the 5th largest importer of oil. So clearly, any upward movement in oil will definitely have an impact on India. Now there are different numbers being put around. Say $10 decline in oil prices would bring down CPI by about say 20 basis points and WPI by about 50 basis points, impact the current account deficit and the fiscal deficit also. So now we've had actually a run of good luck for a while, but with this increase in this, I think till about $60 perhaps, that's also when shale becomes viable, and of course Saudi Arabia says 80 is what makes its oil viable, but I suppose till about 60 is when it's quite manageable
for India.
For India.
Right. Okay. Is that something you concur with, Debasish?
Yeah, I mean, till 60 probably government will continue this fortnightly increases. But we have to also keep in mind that government very smartly and quite reasonably has built up that buffer of excise duty. I'm told that this year itself it would be around 1,70,000 crores. So at some point, if oil starts going up beyond certain levels, it is not that the intention of the government would be to keep passing on that, keeping the excise the same. The whole idea was not to make consumer used to these low oil prices and build that buffer so that every economist said that make use of the low oil prices, invest in infrastructure. So if you look at
have you done that?
But there are also under-recoveries, under-recoveries which need to be taken care of. So I think that's an important factor.
But that's been done now, isn't it?
But there are still some under-recoveries which need to be covered.
By the oil companies?
By the oil companies.
Okay.
So.
No, but coming back to your question, have we done it? I think we made good use of the low oil prices, The entire slowdown in the economy and corporate tax collection was definitely made up by the excise duty increase and series of excise duty increase. And you look at roads and railways; all those investment, the budgetary allocation could not have been probably possible without. If they had just made oil at petrol at 30 rupees.
But is oil going to play a very critical, or how critical a role will oil play in deciding the very future, or at least the immediate future of our economy and all the investments that will go in?
Oil will play a very important role, not just from the economic point of view, but also from the geopolitical point of view. So all that, any unknowns from that side will definitely impact the economy, because right now our macroeconomic fundamentals have been very good, thanks largely to low oil prices. So with this current account deficit, fiscal deficit, inflation, all these parameters have been very good.
Yeah, and you're saying that after $60 it could change. So okay, let's pose that question then, Debasish. So $45 to $55 is what everyone seems to believe will be the band. Is that something that you're comfortable with?
Nobody knows actually.
In the next year.
Yeah, I mean the people. It's directional and sentimental calls. When oil is 27, somebody would say it go to 20. When it is crossing 50, people are saying 80. So these are all directional calls, and the fact remains that it's an oversupplied market, and these are local incidents which may have a few spurts here and there. $80 is not going to happen very soon. Okay. And world can supply, your
so
demand.
So when you say local incidents, you mean Iran, Iraq, Canada, Libya,
No,
Venezuela?
it was really Nigeria.
Okay.
That's the beauty or the scary part of the market. Even if you say that it's a oversupplied market, a bunch of militia in Nigeria can actually dictate the prices.
Right.
And
the fate of an economy like India. I mean, in a very stretched way. But
if it really doesn't shoot through the roof, I don't think Indian economy as such, like she said, till $60 we are good, and I don't think it is going to run in a hurry beyond that.
Right. Okay. So let me ask the next question: is there? I mean, we obviously have our own production as well, but it's only 20% of total requirement. Is that something that could change potentially? I mean, in terms of our own ability to produce, energy security, and so on.
Not in a hurry.
Okay.
Because it takes a lot of time, and that in last 6 years there has not been any auction rounds. Only now government is doing the road shows for the small and marginal fields, which they are calling the discovered fields. Again, those things are basically not going to give you the kind of increase that is happening. India today is around 4.3 million barrel per day. That's the consumption we have. We consume more oil than Africa, by the way.
Okay, all of Africa.
All of Africa.
Okay. That's interesting.
And and we are growing at if you look at the oil consumption, it's probably double digit. Of late the economy is chugging, and that's all happening. We are not, and Mr. Modi has a target of keeping at least 10% reduction in the import dependence, but that's a tough call. It's not only because of the geological factors. India is not a prolific geology.
Yeah.
And at these prices and the margin, it becomes very difficult.
Right, but this is the time that maybe we could have used to acquire oil assets, as we've made some fledgling attempts.
We have done it,
but not enough.
Yeah. I mean, that's always a call. In this kind of low oil price regime, the assets in the markets also come down dramatically.
Right.
You can only have a country to country kind of a deal.
Okay.
You do not have many private deals.
Right, Brinda?
What I would say is that there are forecasts by the IEA that by 2020 India's oil requirements is going to jump 40%. So I think it's high time we looked at alternatives, not just oil fields in other places, but also renewables. So I think this push to solar that is coming in is very timely and very, very good, because we need to expand ourselves. We don't have very much of oil reserves, and neither does the world. And so it's high time now to look at alternatives and particularly reduce our dependence on oil and look at renewables, not only from a green point of view, not only from the environment point of view, but also from an economic point of view.
Right. So let me get a quick outlook from both of you then. Debasish, so if given all of this, given the fact that we have some sense on where oil prices will go, but we are not able to predict beyond that, as you said, given our own requirements, given the fact that we are unlikely to achieve much substitution in coming years, where could things head in the coming quarters?
In terms of a price, or
price
in terms
and
of
price impact on India's ability to absorb.
We personally, I have always maintained that $50 is a sweet spot for India. And that has many other aspects, because your portfolio investment remains intact. Your remittance is not hugely affected, because when oil below $30, it leads sustainable oil below $30, it leads to definite global recession. And that's not good for India. And you saw what happened in our stock markets. Remittances have come down. At $50, the countries in the Middle East, they will take long-term structuring to actually replace the labor force. So that remittance will continue, the investment flows will continue.
No, so you're saying at $50, the Middle East will ensure that things are
they will continue,
made
but
more
it's
robust?
Business as well.
They will continue, okay.
Business as usual.
But less than that, you're saying they'll cut back.
They'll cut back. What happened, below $30 kind of a thing. They never actually have cut back.
Talking about
that. So for India, I think a band between $40 to $50, if it continues for another couple of quarters, that will be a very golden run for India. Then by then, you would have a successful monsoon, your other parts of the economy would have picked up. So oil in these 2 years would have helped India in overcoming some of the very tough economic times.
Right, and particularly something that we've been carrying over. What's your sense, Brinda? Outlook.
Oil will continue to remain low, mainly because the global economy is not growing very fast. We don't expect any jump in a hurry. Not just the developed economies, not just EU and Japan, and but also emerging markets themselves are slowing down. So that is going, and China, the biggest elephant in the room. So all this is definitely going to make sure that oil prices don't spike up sharply, and they would remain, say maybe as 40 to 60 perhaps, but they would be.
But there's also a sense that this golden period might end soon, and therefore we should be getting ready to.
Absolutely, I think that is true. It's high time. I think we did get a window of opportunity. Now we really need to be prepared. So this slowdown, it's time to introduce really the structural reforms and make sure that the economy starts picking up speed.
Okay, so one example of that, very quickly.
The GST, of course.
Okay, great. So you're saying bring about greater internal reform so as to,
My other point is that, we need to also lower our dependence on oil and increase the dependence on gas. What will increasingly happen is both of these will get decoupled because LNG is becoming a global commodity. And the price movement for LNG, which were earlier oil linked, are increasingly contracts will be, gas on gas. And India's economy, I think, are just 7-8% of primary energy is gas based, which is the world average is 25%. So to reduce dependence on oil stocks, I think we need to have gas, and that needs creation of huge amount of infrastructure.
To receive and distribute in terms of pipelines and so on. We've unfortunately run out of time. Thank you both so much. We've run out of time on Policy Watch. We'll be back next week, same time. Thanks for watching.